No, I only got assigned as a problem. I had no other options. My like personal things.
Are we normal? I know.
And then I don't know.
I like.
5 pages in.
You talk about getting kicked out.
I do talk about that.
What was that guy's name?
Mike, man.
We're getting started though. Look at you.
That's so funny. It was so bad.
I don't think we're getting slimed out by
Yeah, I know, and it's so early on too. I was talking to my mom about it. I was like, yeah, like I have a really fast turnaround with my tax team. She's the one that we started with, and I was like, no, but I need time to study.
In my life.
But we kind of just like guessed.
Like, you know when you like describe a package and you like it was like I've never been.
Good up from
The good app.
Just like taking like a look over classes or attention a little better. Getting nothing. Probably like his old friend would be calling me because she worked in the house. And they like needed her to see her.
Oh, sorry, say this here.
I will soon. Maybe she got her this too.
I don't think we were going to have
14 days.
I don't know why we spent all this money.
I know.
Okay, hello everyone. You all had a good weekend. Shop to the system, the final is 2 weeks from today. Right? Time flies. So we're early. I don't set when the time is. I know that's during reading days, but the university sets when final exams are, and I can't move it because some people then will have a conflict. So, and it is at 1 p.m. in Bauer Hall 230, up one floor. You will have the fully allotted 3-hour time. I don't think you'll need that. It might be slightly longer, just maybe 1 or 2 more multiple choice, maybe 1 more short answer from the midterm. So the degree of material, the amount of material question on the exam doesn't greatly exceed that. So I don't think, I've learned in the past that I can expand the volume of questions to get 3 hours of time, but it doesn't change the grades that much because I can test you for 10 hours and I'm sure your grades are going to be the same as if it was 3 hours. Okay, so let me know as you're reviewing materials. It is comprehensive, but I would argue that when you start looking back at the stuff we did in the first half of the semester, it's going to be pretty rudimentary compared to where we are now. We're just building on things and we're much more knowledgeable about corporations now. Same format, multiple choice, short answers, study the examples. Don't just read the examples, but could you do that? Could you respond to that with that answer that's given in the examples, right? That's a good way to think about stuff. If you have any questions as you're preparing over the next 2 weeks, please send me a note. I'll knock it out on email or jump on a quick video call and we can talk about it. Any questions? You'll have twice the number of notes, so you get 2 sheets of paper, front and back, so 4 pages of notes. Please do not over-rely on that. You can't come in with just everything written down and expect to do well in the exam. It doesn't typically work out well that way. So do some independent thinking and learning on this stuff. Questions? Okay. I will have a better sense as to where our cutoff will be after the end of this week. I was talking to Marissa. What I usually do is start to try to truncate down the remaining topics, so I give you a flavor, but I'm not going to just slam a bunch of information through. That's not productive to anybody. I'm going to help you learn, but I'll just try to give you a flavor. And So I'm gonna start shrinking down the partnership stuff that we're gonna start covering, and then I'll probably greatly shrink down the S corporation stuff. Just again, I want to introduce some topics to you so you kind of understand them. We just won't go into the level of detail. So, whatever we talk about in class can be on the exam. So there'll be much more in the chapters that will be covered as I fit it into what we have left. Okay. Okay, we have just a little bit to do on chapter 8, and we are done with corporations. Okay, and I understand there's been a lot on corporations, but this is kind of the meat and potatoes of tax consulting. Okay, so we talked about the requirements of non-taxable reorganization, right? We talked about the A variation, A reorgs, and B reorgs, the share-for-share stuff. What I wanted to talk about here is just the applicable judicial and regulatory doctrines that also apply. So you have to meet these as well. You have to meet those requirements on the A reorganization, whatever flavor you're trying to go for. Remember we talked about the traditional A, then we had the forward triangular, the reverse triangular, and then we had the share-for-share and the B. You have to meet those requirements, but you also have to layer on judicial and regulatory. So the regulatory doctrines come from the Treasury Department as well, and they put forth the view of the government's explanation of the statutes. So what we talked about earlier was the statutory requirements, the law as passed by Congress, signed by the President, those requirements. The regulatory is the Treasury Department's view of those rules. Usually what they are is they're just expanding on things. We also have judicial doctrines, so this body of law is very stable, doesn't change a whole lot compared to other areas of tax law. But we certainly have a lot of judicial court cases over time, given the size of these transactions that has developed over time. So you have to comply with those that are on the sides of those as well when you're looking at these things. So the first one is a regulatory doctrine called the continuity of shareholder interest. People call this COSI, continuity of shareholder interest. And the non-taxability of reorganizations, as we talked about, is based on the presumption that the target corporation shareholders retain a continuing interest in ownership interest, albeit indirect, in the target corporation or its underlying asset through ownership through the acquiring corporation, right? We're going to have a significant stock element to the transaction. So I look through that stock I received and I can still kind of see the assets I used to own, be that target stock or target assets. So that is enveloped in the continuity of shareholder interest. That you were a shareholder before, you're still a shareholder after, but through the acquiring corporation stock. Although there is no bright line test to establish whether COSI has been met, tax regulations provide an example where COSI was satisfied when the shareholders of the target corporation received acquiring stock equal to 40% of the total consideration received. That's consistent with that element. We could have 60% cash in the A reorganization, right? So you can cash out, but you have to have a significant portion of what you receive in the transaction has to be acquiring stock. So you can look through that to those assets. That's the continuity of shareholder interest. Okay. The second one is continuity of business enterprise, called COBE, not the state. COBE, continuity of business enterprise. For a transaction to qualify as a non-taxable reorganization, the acquiring corporation must continue the target corporation's historic business or use a significant portion of the target corporation's business assets in a business. So if you're acquiring target corporation stock, target corporation has to still be involved in a business post-reorganization. You acquire the assets of the target corporation, you have to use those assets in a business. Again, we're trying to think of reshuffling an existing set of businesses, right? The government wants the business, there was business being done before, is it significantly being done afterwards, okay? tax regulations suggest that an acquisition of a corporation with 3 equal business lines, an acquiring corporation can meet Toby if at least one of those lines is continued after the transaction. Right? So many times you acquire businesses and you have there's part of the business that you want and part of the business you don't want. But if you're acquiring target corporation stock, you get everything that's in that target corporation, right? So what this regulatory example is saying is if your target corporation was in 3 equal lines of business and you discontinue 2 of them post-transaction, you're still considered to continue the business enterprise because you kept one of the businesses alive. So pretty low threshold, right? You can exit a significant portion of the business, you don't have to keep that going, but you still need to have at least one going post-transaction. Whether the historic business assets retained are significant is a facts and circumstances test which adds to the many regulatory and judicial rulings that are prevalent. So, tax opinions I've mentioned that support these transactions, they can be issued by accounting firms, they can be issued by law firms, many times by both, right? Because companies want to be really comfortable that they have a non-taxable transaction. They're covering this as well. Looking at the transaction, do you meet COSI, do you meet COBE? And here's the reasons why. But that's why these documents can be hundreds and hundreds of pages long, given the volume of analysis it has to be. The third one is really important, business purpose. We've covered this, touched upon it in several instances, but transactions lacking business purpose are not entitled to non-taxable treatment, even if they meet all the statutory requirements. So if you went through those, look back a few slides, and you go through and you're trying to do an A reorganization, and you meet all of those requirements, no doubt about it, everybody agrees, but you do not have a business purpose underlying your transaction, the government can preclude you from having non-taxability in that transaction. Now the good thing is for most publicly traded transactions, publicly traded entities involved in transactions, the business purpose is readily apparent, right? Because think of a share for share exchange where one publicly traded company is acquiring the shares of another publicly traded company. You're not going to do that for other than business reasons, right? These are massive transactions. You either want to grow the business or expand in their business where you are not. So there's a readily apparent reason. That's the first thing the CEO talks about when they announce the transaction is the rationale for the business. That's what they're asking shareholders to approve for these reasons. Where you get into business purpose is, remember, we can do these transactions internally as well. We have a parent organization, we have a bunch of subsidiaries down below. I can start doing A reorganizations and B reorganizations down below without any public transaction, right? I'm just restructuring my own business. That's where business purpose is more susceptible to being challenged because you don't have that overriding shareholder vote, make your case to the public as to why this transaction makes sense from a business perspective. You might be doing something that might have an element of tax planning in it. You see this a lot post-transaction, post-big transaction. Remember I mentioned all the integration synergies that you would have to do afterwards? That goes on for months, maybe years afterward, where you have 2 Canadian subsidiaries now because you acquired a Canadian company. You want to combine those, you want to combine the Korean subsidiaries, you want to combine the Chinese manufacturing operations. You might be doing all those in non-taxable transactions. You need a business purpose for each one of those transactions. Now, that could be as simple as redundancy reductions, efficiencies. I want to get the 2 sales teams together. I want to have one IT group. I want to have one IT system. All of those things but you got to make that case, right? Especially if you have an element of tax planning in the transactions. When I was working on those particular transactions, usually as a post-integration type set of transactions, I would use my PowerPoints to put forth my business case for what I was doing. Like, why was I combining the Canadian subsidiaries? Synergies, efficiencies, accounting treatment, all those things I want to put in there, but I document those so that if years down the road, the Canadian government wanted to look at the transaction, I'm like, here, look at it, and right at the front end part of it, I articulate the business purpose of the transaction. Okay? So, but business purpose is very important. You can't just meet the statutory requirements. You also have to have a business rationale for the transaction. Okay? So that's it for reorganizations. Okay? Our last corporate topic is liquidations. And again, think of these things in the timeline, right? We started with forming corporation, we're in the middle, we're operating, we're maybe doing some reorganizations, maybe we're doing some M&A transactions. There could be a time when you come to the end where it's time to wind up the corporation. I want to cease being a corporation, right? That could be for any number of reasons. It could be the business is no longer profitable, right? I want to liquidate the corporation. It might be I want to change the organizational form of the business. What if I don't want to be a corporation anymore? That double taxation we started back way back. Maybe I don't want that anymore. So I want to go and see if I can be a flow through it. I have to wind up the corporation to do that. I have to terminate that. It could be a desire to consolidate the operations of a subsidiary with its parent. Maybe I want to liquidate the subsidiary into the parent so that all the operations are done in the parent organization. So any number of reasons I could decide I want to liquidate the corporation. We're going to be talking about complete liquidation. So a complete liquidation occurs when the corporation, the liquidating corporation, acquires all of its own stock from its shareholders in exchange for a distribution of its net assets. Okay. Contrast that with a partial liquidation, which is the corporation does not go out of existence. I'm just liquidating the interest of a particular shareholder. Complete liquidation, I'm liquidating all of the interest of all of my shareholders. I like to think of it as you're distributing your balance sheet up to your shareholders and they give you all your stock back. Under state law, that cancels the stock and you're done. You wind up as a corporation. Okay. The tax consequences to a shareholder in the liquidation depends on two things. Is the shareholder a corporation or not? Okay. And if the shareholder is a corporation, how much does it own in the liquidating corporation? If you answer those two questions, you will get the tax implications of liquidation of a corporation correct every time. Okay. So we're gonna talk about these at the shareholder level and then at the liquidating corp level. Okay. So first we're gonna talk about shareholder tax consequences. So for non-corporate shareholders, so that first question I just need to answer: do I have corporate shareholders or not? I don't need to analyze it for every different type of shareholder, but is it? If it's an individual, a partnership, a foreign party, any of those things, as long as it's not a corporation. Okay, that's what we're going to talk about first. So, we're going to talk about taxability and tax basis implications. Because again, I like to be methodical in going through these things. Don't mix up the different types of analysis. So, if I have a non-corporate shareholder and I do a complete liquidation, non-corporate shareholders have a taxable transaction when they liquidate the corporation. Okay. What does that mean? The shareholders treat the property received from the liquidating corporation as being received in full payment for their stock in the liquidating corporation. It's no different than if you sold the stock from a tax perspective. Meaning the shareholders calculate a capital gain or loss under the normal rules for doing so. Subtract your tax basis in the liquidating corporation stock from their amount realized, i.e., what is the fair market value of the net assets that you receive. Right? You're exiting the corporation in a capital gain or loss, no different than if you sold the stock to a third party, right, without a liquidation. So, and that's only if you're a non-corporate shareholder. So, given the liquidation is taxable, the shareholders take a tax basis in the assets equal to the liquidating corporation, from the liquidating corporation equal to the fair market value. So whatever you receive that in a taxable event. No different than if you acquired something, right? When you acquire something, that's a taxable event, like purchase. I don't mean a non-taxable reorganization. So you go out and purchase something, your basis is your fair market value of what you just purchased. You acquired these assets in a taxable transaction as well. It's a liquidation, therefore you have fair market value basis in those assets. Okay? Non-corporate shareholders typically involve individuals, that's the easiest way to think about it, but also remember, it could be partnerships. A partnership could be a shareholder and owns stock in a corporation. If that corporation liquidates, then that shareholder is the partnership that is a non-corporate shareholder. Right? Individuals and partnerships is what we're looking at typically in this scenario. Okay, let's do 8 to 22. 8 to 22 is Marissa. It's a long one, but straightforward.
So as a result of the liquidation of 360 Air, Ginny received cash of $45,800, representing 10% ownership in the company's assets of $458,000 after all debts were paid. Ginny's tax basis in the stock is $60,000. So what amount of gain or loss will Ginny recognize on the exchange of 360 Air stock for 360 Air assets? And the answer to this is Ginny recognizes a long-term capital loss of $14,200 by looking at the amount realized of $45,800 less the tax basis of $60,000. The entire amount could be deductible to the extent of Ginny's capital gains. Otherwise, Ginny can offset this loss against capital gains and deduct an additional $3,000 of net capital loss. Any unused capital loss carries forward.
Yeah, so first we answer, do we have a non-corporate shareholder? Yes, Ginny is an individual, so we know it's taxable, and then it's your normal computation of gain or loss. And those last few points that you made bring you back to individual income taxation, right? So we want to kind of carry over concepts from courses, right? So we know that Ginny now has a capital loss. Capital losses can offset capital gains. 100% of your capital gains can be reduced by a capital loss. So if she had $45,800 of capital gains, she could reduce that capital gain to 0 by virtue of this capital loss. If she doesn't have that, then she can use up to $3,000 of the capital loss to offset ordinary income, right? And then that excess capital loss carries forward to the next year, right? All the individual stuff we did semester ago. Okay, but
So continuing on with this, we're now looking at Jacob, just noting that it's also another individual shareholder. So as a result of complete liquidation, Jacob received $183,200 in cash, which represents his 40% in the company's assets. His tax basis is $240,000, an amount equal to the cash contributed that he put in the form. So it's asking about his gain or loss recognized on the exchange of his stock for the assets. And the answer is he has $56,800 of a long-term capital loss. Looking at his $183,200 he got in cash, less the tax basis of his stock, $240,000. The entire amount, yet again, could be deductible to the extent of his capital gains, and otherwise, like we were talking about, you have the offset this loss against capital gains and deduct an additional $3,000 of loss, and anything carries forward. And then finally, the what if, suppose that the land owned by 360 Air consists of 2 parcels. The building is located on parcel 1, which has a value of $50,000 and an adjusted basis of $40,000. Parcel 2 is an undeveloped tract of land with a value of $150,000 and an adjusted basis of $60,000. Further, suppose that rather than selling parcel 2, 360 Air distributed parcel 2 and $79,000 cash to Al. This consideration represents Al's 50% interest in the net fair market value of the company, 50% times the $458,000. Al's tax basis in the stock is $100,000, and we're looking at the gain or loss that Al recognizes. So we see here a $129,000 long-term capital gain computed as the amount realized, looking at the $150,000 plus the $79,000 is $229,000, less Al's adjusted basis of $100,000. And so what is Al's basis in the land received in liquidation? It's $150,000 equal to its fair market value because it's a taxable transaction.
Perfect. So we had 2 shareholders who had losses and 1 had a gain. That just depends on when what they put in and what the basis was in the assets they put in, right? You put in cash and it went down in value, you're gonna have a capital loss. Al might have put his, I don't remember what the facts were way back when we formed this entity, but I could have put in assets that I had to carry, I had a substituted basis in the stock, right? If I put in low basis assets, then I have low basis in the stock, which may now have been recognized on the complete liquidation that caused me to have a cap gain, where other shareholders have cap losses. Okay. Taxable because I had individual shareholders, and then simple because the computation is what we've talked about many times before. Okay, So that's non-corporate shareholders, right? Taxable to everybody. For corporate shareholders, remember I had the second question was, if I do have a corporate shareholder, now I have to ask the question of how much stock do they own? Okay? If I have a corporate shareholder who owns 80%, if I have a corporate shareholder who owns 80% or more, measured by voting power and value being because preferred stock counts here, of a liquidating corporation do not recognize gain or loss on the receipt of assets distributed by a liquidating corporation. Okay? So I have non-taxability if I have a corporate shareholder who owns a liquidating corporation to the extent of 80% of that. I think the reason for that is because the assets really haven't left corporate entity treatment yet, right? They were in a subsidiary, they moved up in the liquidation largely to another corporation. They haven't, remember the reason we have taxability as in the first scenario when non-corporate shareholder is because I've broken the corporation, right? It's no longer separate taxpayer because I liquidated it, it's gone. So that's what causes taxability. Here I didn't really separate it, it just really moved up one level to a super controlling shareholder, an 80% corporate owner. Okay, so what would you expect from a tax basis implications? If I tell you a transaction is non-taxable, you're going to have some carryover basis in the assets, right? That's how the government does not exempt or forgive the taxation, it's just not now, right? It's a deferral mechanism here. So no gain or loss is recognized, a corporate shareholder takes a carryover basis in the assets received from the liquidating corporation. So if the corporation, the liquidating corporation has gain or loss in its assets, that simply moves up to the 80% corporate shareholder. Right? Many times you see this as 100% ownership. So if I'm doing something from an integration perspective, like I buy another multinational and we both have Canadian subsidiary, I might move the one target Canadian subsidiary underneath my Canadian subsidiary and liquidate it. That might be 100%. That makes perfect sense to me that I should be able to do that transaction non-taxably because the assets are still in corporate form. And the government's not worse off because I preserved the gain or loss in the assets by a carryover basis. So that I just, again, kind of restructured my business a little bit there. Okay, 2823. Esmeralda.
Suppose 360 Air was a 100% owned subsidiary of SCR, and 360 Air is liquidated into SCR. SCR has a tax basis in its 360 Air stock of $300,000. What amount of gain or loss will SCR realize on the complete liquidation of 360 Air stock for 360 Air assets? Answer 200,000, because 500,000 minus 300,000.
Because that's realized as an economic concept. So I exchanged stock for assets, right, from the corporate shareholder perspective. And again, this is where I always like pictures, so it's up to you guys. But if it helps you in an exam, I would write down my structure and then depict it. That's a liquidation. The way I would show that. Make sure. Oh, okay. Now I got a corporate shareholder. If I answered the question is about realizing gain or loss. That's the economic concept. I got 500,000 of value, and I only had 300,000 of basis. That's 200,000 gain realized. Okay.
What amount of gain will SCR recognize on the exchange? Answer $0. The gain is not recognized because SCR owns 80% or more of 360 Air. What is SCR's adjusted tax basis in the assets and liabilities it receives in the liquidation? Answer, SCR will inherit a carryover tax basis in its 360 Air's assets and liabilities.
So that's a carryover basis, right? The basis carries and follows the assets as they come into the 360 or into the SCR balance sheet. Okay. Now we're gonna shift down to the liquidating corporation. So we covered the shareholder side. If it's non-corporate, it's taxable. If it's corporate, it can be non-taxable, but only if the corporation owns greater than 80%. You know, 75, it's like the individual, and you have the same computation. It's your amount realized over your basis, fair market value basis. Yeah. So now we're gonna look at the liquidating corporation side. The reason we gotta look at the liquidating corporation is it's a separate taxpayer. Right? It goes out of existence. So in a taxable liquidation, it's a taxable event at the corporate level of the liquidating corporation. So a corporation that liquidates in a taxable transaction, so those can be cases with non-corporate shareholders or when the corporate shareholder itself does not own the required 80%. In a non-taxability, then the corporation recognizes any built-in gain or loss in its assets. Basically like just a complete flush out of sale of all of its assets and all of its assets, or the amount realized less the adjusted basis. That goes on the final tax return of the liquidating corporation. 20 is Asia. Snuck up on you.
Sorry.
Assume 360 Air was 100% subsidiary of 360 Air made taxable liquidating distributions to Jacob, Jimmy, and Al during
So this
the
is
current year.
this is the liquidating corporation side of the example that Marissa went through. She went through the shareholder side. This is the liquidating corporation side.
Al owns 50% of the stock, Ginny owns 10, and Jacob owns 40%. So for purposes of this example that 360 Air made a pro rata distribution of each asset to its three shareholders. The company's tax accounting balance sheet at the time of the distribution is shown below. The FMV of cash would be 138,000. The adjusted tax basis would be the same. Accounts receivable FMV would be 2,000. Adjusted tax basis the same. Inventory FMV would be $10,000. The adjusted tax basis for that would be $12,000.
Which is weird, where you have a loss in your inventory. It's not a good business model.
We realized $2,000 of loss. Building, the FMV would be 150,000, and the adjusted tax basis for that would be 48,000. The difference would be 102,000 gain. And last, the FMV for land would be 200,000. The adjusted tax basis would be 100,000. The difference would be again $100,000 of realized gain. So the total FMV would be 500,000. Adjusted tax basis 300,000, and the difference would be $200,000 realized gain. So, what amount of gain or loss does 360 Air recognize as a result of the distribution? 200,000. So 360 Air recognizes all gains and losses at the distribution of its assets in the following amounts and characters. So the loss or gain recognized for inventory would be $2,000 as ordinary income. The gain recognized for building $102,000 would be ordinary $291 and section 1231.
Yeah, so ignore the 291. For our purposes, it would be a 1231 asset. Remember that, what that was? That's used in a trade or business held for greater than a year. That was the case here. That would be a 1231 asset. What's the implication of a 1231 asset? I got to recapture gain as ordinary to the extent of accumulated depreciation. Right? That would have caught. I got to give back the depreciation which caused me to have a gain. Okay. 291 is just the mechanism to get that real property building into 1231. Level of detail that we just didn't dive in.
So the gain or loss recognized for land is 100,000, and that would also be ordinary 1231 asset. So the net gain would be 200,000. Now the gain or loss on the complete liquidation is identical to gains or losses that would result if 360 Air had sold all its assets at fair market value.
So because this is taxable, because I have all individual shareholders, I have taxability at the shareholder level, I have taxability at the liquidating corporation. Just think of like you had a fire sale and you sold all your assets, right? What's the value of those, what's the adjusted basis, and then the character, I have to look at each line item, right? Perfect. Okay, non-taxable liquidations. A liquidating corporation does not recognize the built-in gain or loss in its assets in a non-taxable liquidation. So non-taxable at the shareholder level, because I have an 80%, at least an 80% corporate shareholder. So I have non-taxability also at the liquidating corporation level. Complete non-taxability to the liquidating corporation is the case even if there are some shareholders who recognize gain or loss on the liquidation, i.e. when there are less than 20% owners present, be that corporate or non-corporate. Okay, so that's just a little nuance. If I have an 80% corporate shareholder, that is non-taxable to them, completely non-taxable to the liquidating corporation. If I don't have 100% corporate ownership, so there's other shareholders, be it corporate or individuals or partnerships who fill in that gap between I'm above 80 but not 100, then it's still completely 100% non-taxable to liquidating corporation, even though those shareholders have a taxable event, right? Because the only one who doesn't have it at the corporate, the shareholder level is the 80% corporate shareholder. Okay. That makes sense? I think that's just a rounding mechanism to keep it simple for the corporation, that they don't have a deemed sale of 5%, 10% of their assets and having to deal with that complexity. But your shareholders still have that taxable event. They're not the 80%. 80% corporate. Okay. 825 is August.
Assume 360 Air was 100% owned subsidiary of SCR, and SCR liquidated 360 Air. SCR has a tax basis of its 360 Air stock of $300,000. The company tax accounting balance sheet at time of distribution is shown below. What amount of gain will SCR recognize on the exchange? The answer is 0. The gain is not recognized because SCR owns 80% or more of 360 Air. What is SCR tax basis in the asset of liability received? The answer is ICR will take the same basis line as 360 Air has in each of the assets and liability it received in the liquidation as a carryover basis.
So you just have to answer those two questions. Who are my shareholders? Is if it's non-taxable, then it's non-taxable to everybody, and that will answer your basis question as well, which means carryover basis, right?
Suppose ICR owns 80% of 360 Air is not 100%. Will SCR recognize any gain or receipt on the liquidating for 360 Air? No, because SCR owns at least 80% of the 360 Air. It does not recognize any gain or loss on the receipt of the liquidated distribution, and it takes the carryover listing property and the liability received from 360 Air. If SCR owns less than 80% of the 360 Air, the distribution will be fully taxable of SCR, and SCR will take a fair market value basis of the receipt.
So that's just trying to, that scenario where I'm over 80 corporate owned, but not to 100%. The liquidating corporation is still 100% non-taxable. My shareholders, my minority shareholders have a taxable event, or because they're not over 80 as a corporate, or they're not. Okay, so we covered a lot in this chapter. I want you to think about it through the lifeline. Understand the formation of corporations, which is the 351 requirements. Remember, I had 3 requirements: transfer of property in exchange for stock, and I have to own, transferor group has to own greater than 80% immediately after the transaction, right? And then we had boot in that transaction. That adds an element of taxability to the whole situation. Then we had acquisitions. Go through your taxable acquisitions. That's taxable. I can either acquire stock or assets of a target corporation. The distinction being, remember the basis that I would get in the assets. If I buy assets, now I got tax basis in the assets equal to the fair market value. And I also get tax basis in goodwill, which is then subsequently amortized. If I buy stock in the target in the taxable acquisition, my basis is stuck in the stock. I do not get a step up in the underlying assets. But for that special case where I mentioned section 338, where I can treat that stock acquisition as an asset acquisition. Then we have non-taxable acquisitions. That's all my M&A transactions that are A reorgs, B reorgs is what we talked about, and then the liquidations of our corporations. Okay. All right. Now we're going to shift. You're going to have to rewire your brain. Okay. Partnerships are different. They are different. Okay. They're different in a fun way for a tax person, but they are different. And the fundamental difference is because of that flow-through nature of partnerships. Okay. Chapter 9. We're going to cover in Chapter 9 kind of the first two lifetime changes of partnerships. First, we're going to form a partnership, just like we did when we formed a corporation. And we're going to operate a partnership, and I'm going to show you how that happens. And then we're in Chapter 10, we're going to talk about some transactions relative to the partnership. So, the tax implications of business entities taxed as partnerships differ materially from those of corporations. Income earned by partnerships is not taxed at the entity level, right? That's the seminal difference between partnerships and corporations is they're not a separate taxpayer. They're a separate business, but they do not pay tax. All their results flow through to the partners for taxability. Unlike corporations, partnership income is only taxed once, right? At the owner level. Corporate income is taxed twice. Once at the corporation, and then if I distribute after-tax earnings, then the dividend is taxed, right? So those aspects are what drive the fundamental differences with partnerships and corporations. Business entities legally organized as a general partnership, a limited partnership, or a limited liability company that has multiple owners, so not a wholly owned LLC, but multiple owners of an LLC, are treated as partnerships for U.S. income tax purposes unless they affirmatively elect to be taxed as corporations via the entity classification election regime. Remember the check the box rules we talked about? General partnership, a limited partnership, and LLC are eligible entities, so I could choose to have them taxed differently than a partnership. If I don't so choose, they default to being taxed as partnerships. The rules for taxation of partnerships are found in subchapter K. That is the area of the tax code where these rules that we're going to cover are housed. It's called sub K. So when tax people are talking about, oh, that's a sub K person or they're a sub K partner, they deal with partnerships. Okay, and it addresses all parts of it, from formation and operation of the partnership to the sale of partnership interest to the liquidation of partnerships. Just like what we kind of a lifeline that we talked about of a corporation, same thing can happen with a partnership. You form it, you do lots of things and operate it, and you can liquidate it at the end. So we're going to start with formation. Partners may contribute cash, other tangible or intangible property, and services to a partnership upon formation and afterward. So it's not just on formation, right? It's a living thing. So new partners can come into the partnership in exchange for an ownership interest in the partnership, commonly referred to as your partnership interest. Okay, so when you hear people talk about partnership interest, that is not interest income paid by the partnership to you, right? That's your ownership interest. That's your equity in the partnership. We just call it a partnership interest, but think of it in terms of ownership. They represent, partnership interests represent the bundle of economic rights given to the partners under the partnership agreement. Remember, way back, we talked about chapter 4 was our first topic, and we compared and contrast the different elements of business entities. And one of the features of a partnership, one of the non-tax features of a partnership that was very attractive was our ability to be governed by a partnership agreement, right? Extremely flexible. People can get together and form a partnership and decide how they want to run their operation via the contract that is the partnership agreement. Who's going to do what? Who gets paid what? Who makes what? That type of thing. How can you exit the partnership? when I was admitted at PwC, I signed the PwC partnership agreement. Right, that was the document that was 60, 70 pages long, but that governed the interaction of all the owners of PwC. Right, and it's as flexible as it could be, right? However they decided to do that, and I could choose to be a part of that or not. But that was the document I signed. Very different than a corporation, right? If you're the owner of a corporation, you own stock in that corporation. You have certain rights as a shareholder, but you don't have a lot of flexibility. There is no corporate contract amongst the shareholders of how you get compensated and that type of thing, which is what you have in partnership. George.
So when the partnerships are elected to be taxed as a corporation,
So if I have a partnership and they've affirmatively elect under the entity classification election regime, the check the box regime, to be considered a corporation, then they are treated just like a corporation. So everything we talked about in the prior chapter is applicable. So if you form it, you have to be in 351, because that's the formation rules for transferring property to a corporation, not the rules we're just about to talk about here. So that's where you gotta have the two hats, right? You have your US tax hat, you've elected for it to be a corporation. I need to forget it's a partnership, I'm in the corporate world. Whereas everybody else you're gonna talk to is gonna say, well, that's an LLC or that's a partnership. Yeah, but you made an election to treat it as a corporation. So when I'm looking at your US tax application, I have to only look at it as a corporation. But everyone else, accounting, treasury, gonna look at it as a partnership.
so what could be the reason why they?
The reason you might do that, good question. The reason you would do that, so this would be technically a reverse hybrid. If you go back and look at our entity classification, it'd be that envelope, because it's legally a partnership and I check it to be a corporation. The reason I might do that is I want the taxation at the corporate level for US tax purposes, but for a non-US jurisdiction, they might treat it as being at the owner level. Remember, it's going to be a partnership for foreign tax purposes. So let's say I form a Canadian partnership. I check it to be a corporation. We're going to see it as a Canadian corporation, so all of its income stops at that entity until it makes a distribution. Canada is going to see the taxpayer being up above it. I might have a tax planning idea that might be applicable to. It would be a rare fact pattern, granted, not normally going to do it that way. Reverse hybrids are not nearly as common, but it's usually that disconnect between the United States rules and a foreign country. Yeah, you don't just check the box or choose your classification without there being a driving reason for doing it. So you would ask the question, why are we trying to do this? What are we trying to accomplish? Okay, there are two types of partnership interests. The ownership interest in the partnership. There is a capital interest. That is the right to receive the share of partnership net assets if the partnership is liquidated. So you're very much like a corporate shareholder. If we wind this up, I'm going to be the last one in line and I can get some of the net assets. I'm an owner of the capital of the business. Contrast that with the profits interest. That I don't have the right on liquidation to any net assets, but I do have the right to receive a share of future profits or losses in the business. So like the ongoing operations of the business can be. So again, the flexibility of partnerships. I can have capital partners, I can have profits partners. That's all in the partnership agreement. And I have great flexibility in structuring that ownership arrangement amongst the different owners. Partners are classified as general partners and limited partners for tax purposes, with the distinction between the two primarily determined by the degree of involvement in the partnership operations. If I am involved in the operations of the partnership, I work there, I make decisions about it on a nearly daily basis, I am going to be potentially a general partner in that business. If I am not involved, then I may be able to fall to a limited partnership. The degree of legal responsibility the partners bear with respect to partnership level liabilities. If I'm a limited partner, my investment is limited to the amount I invested in the partnership. If I'm a general partner, then I have unlimited liability, meaning that partnership disputes or liabilities can go to the personal assets of the individual partner. Okay, so you'll have general partners and limited partners. You wouldn't be surprised that most partners like to be limited partners because that limited liability is very appealing. You don't want to have your personal balance sheet at stake. Sometimes that can be overrun by being involved in the day-to-day operations of the business. Okay, so let's talk about the formation of a partnership, and we'll do this at the partner level, and then we'll do it at the partnership level. So at the partner level, when forming a partnership, so a contribution of property to a partnership in exchange for a partnership interest, that's my equity, that's my ownership that I get back, can be structured as a non-taxable transaction, similar to the contribution of property to a corporation in exchange for stock that we covered in corporations under 351. This is actually 721 in subchapter K. So that's the rules that say I can put property into a partnership and get back equity, ownership, partnership interest in the partnership, and do that on a non-taxable basis. The underlying rationale is similar between forming a corporation and forming a partnership. The tax law should not be an impediment to organizing a taxpayer's business, and the taxpayer continues to have indirect interest in the property transferred indirectly via its partnership interest. So, tax code does not want to frustrate the ability to form partnerships. They view that as a business activity that we want to encourage, right? And you haven't sufficiently disposed of the asset. Just like when we talked about corporations, right? You used to own the asset directly. Now you own a partnership interest, but through the partnership interest is the assets. So you still have line of sight to the assets. That's the rationale as to why we don't tax these transactions. Now, again, not forgiven, not excluded, we're going to defer the gain. Meaning that formation of the partnership, we're not going to tax it now, but we might want to tax it in the future. You can guess how we're going to preserve that basis. Right? Our basis determination is going to be important here. Importantly, there are no ownership percentage requirements for transfers to a partnership to be non-taxable. Right? Remember when we transferred to a corporation, we had to have a controlled group own 80% immediately after. We have no such ownership percentages in a partnership. So when I put cash into PwC and I got my very small partnership ownership, that's fine, that's non-taxable. There's no ownership percentage that I had to get back. Okay? Again, much more flexible. Flexibility, you'll see a theme go through partnerships, much more flexible. Right? Both on operational governance and tax. Much more flexible. Okay? The non-taxability applies to both built-in gain and built-in loss property and both partnership formations and subsequent contributions. So, just like when we met the requirements of 351 in corporate setting, if I'm contributing built-in loss property, I defer the recognition of my loss. Right? Normally I don't like to defer losses, I like to recognize losses. But if I meet those requirements, I'm deferring the loss. Same thing applies here. If I have a piece of land that just has to happen to have a fair market value below my tax basis, contribute that to partnership, it's deferred. And the last point here, this applies to when I first form the partnership and if I subsequently admit a partner down the road. Partner comes in, drops in assets, as long as they get back a partnership interest, not taxable. They can get 0.0001% of the partnership, that's fine, non-taxable. Okay, 9.1 is Eva.
What amount of gain or loss would she recognize on contribution? None, because under the general rule for contributions of appreciated property, Nicole would not recognize any of the 100,000 of any gain.
Suppose Shands Inc. contributed equipment at a fair market value of $120,000 and a tax basis of $220,000 to CCS. What amount of the gain or loss would Shands Inc. recognize on the contribution? Again, it would be none because, but if they had sold the property to an unrelated person and contributed $120,000 in cash instead of the equipment, it could recognize the $100,000 both in tax loss. If for some reason the equipment they had planned to contribute was uniquely suited to CCS's operations, they could obtain the same result by selling the equipment and contributing the cash received from the sale to CCS.
Yeah, so a couple things going on here. The first, what if Nicole, so it's just comparing an individual becoming a partner, and we can have a corporation. So the second what if is Chan's Inc. means it's a corporation, is also dropping assets in to become a partner. So it doesn't matter the identity of your partner. It could be anyone, anything can contribute an asset into a partnership as long as they take back partnership interest is non-taxable. The last part of the answer here is just saying there was a built-in loss in the property. You would normally like to recognize the built-in loss. So are there other plans that you could do to try to recognize the loss other than contributing into a partnership or a partnership interest, because we know that's going to be deferred. So the idea was sell it to some third party for cash and contribute the cash into the partnership for your partnership interest. That would recognize your loss. Or could you sell it to the other partner for cash and then have that partner contributed in? I would want to make sure there that I wasn't running afoul of any of the related party rules and just make sure that something wasn't going to catch me in that, because that seems kind of cute to me. I'm not saying all those are wrong, but I would just want to double check that. That's just a taxpayer trying to work hard to try to recognize a loss that would otherwise be deferred. Okay, so if I told you that it's really simple to drop in assets to a partnership and get back partnership interest and make it non-taxable, when we started looking at the tax basis in the partnership interest, you guys would tell me substituted basis, meaning that the basis you have in the assets you put into the partnership is going to become your basis in your partnership interest. Right? Your ownership, it is an asset that you have. And you'll see in chapter 10, we can sell that asset. We can sell a partnership interest. Now, you might have to look and see if the partnership agreement precludes you from doing that. My partnership agreement at PwC precluded me from selling the partnership interest to anyone other than the firm, because they wanted to control who was and was not a partner. So you might be precluded from doing what you would otherwise be able to do under the law by virtue of this contract. And that's one of the appeals of a partnership is I can control who my ownership base is, right? Contrast that with Apple. Apple can't control who their owners are, right? Whoever sets up an online account can buy Apple stock, and Apple has no say in saying, well, you can't own that stock. But a partnership, again, with that flexibility, that governance feature can preclude things that you would otherwise be legally entitled to do. So, partner level tax implications. So I have non-taxability, but I used to own assets. Now I own partnership interest. My tax basis in that partnership interest, I take a substituted basis. I substitute the basis I had in the assets that I contributed to the basis in the partnership interest. Now, this is where the complexity is going to start. I want you to start thinking about outside basis and inside basis. Okay? Outside basis is the partner's basis in the partnership interest that they own. Inside basis is the partnership's basis in the assets that it owns. Okay? Because one of the things that we're going to start doing is adjusting outside basis. And that is totally different than the corporate world. You do not adjust your outside basis in your stock in a corporation. It is what you paid for it, right? It's not depreciable, but it's stuck. You buy stock in Apple today, that's your basis. So you sell. Partnership basis or your partner's basis in the partnership interest is going to move up and down all the time. That's your outside basis. So outside basis is above the partnership. Inside basis is within the partnership. Okay. So we're gonna take a substituted basis / outside basis equal to the tax basis in the cash and property transferred. 9.2 is Jacob.
Assume that Sarah contributed $120,000 cash to CCS in exchange for partnership interest and that CCS had no liabilities. What is Sarah's outside basis in her partnership interest after contribution? And the answer is simply 1 to 20,000, which is the amount of cash she contributed to CCS.
So obviously cash, I don't have built-in gain or loss in cash. My basis is my US dollar cash, right? Who's US taxpayer. So if I did euros, that would be different. But if I, my basis is always the full value of my dollar. So that becomes my full basis.
Now assume Nicole contributed land with a fair market value of 120,000 and a basis of 20,000, and CCS had no liabilities. What is Nicole's outside tax basis in CCS? And her outside basis in CCS would be 20,000, which is the basis of the property she contributed to CCS. Now, if Nicole immediately sold her interest in CCS for 120,000, she would recognize a gain of 100,000, which is the amount she would have recognized if she had sold the land instead of contributing it.
Yes, that's our same check computation from all of our non-taxable events that we did on the corporate side, right? If I have non-taxability, that's gain is deferred, not forgiven, reserved within the basis. So if I'm not sure I got the right basis on that second what if here, then test it, right? She has a partnership interest immediately after the transaction. If she sold that, we know what the fair market value is because it didn't change in a day. My purported basis number is correct, I should recognize the realized gain that was deferred. And that's just the hallmark. So now you should be seeing some themes that run through this stuff, right? Basis is preserving the realized gain that was deferred on the transaction. The way to check that is just do an immediate sale. See if you got that right. Okay. One of the elements that is different in partnerships and corporations is liabilities. Okay? When partnerships have liabilities, additional complications are introduced in determining the partner's outside basis in their partnership. If I bought stock in Apple, right, a corporation, and Apple probably has some debt, which they don't need debt, but maybe just from a finance perspective, they have some debt on the balance sheet. Whether that company borrows more or repays some existing debt, that doesn't affect my tax basis. Right? My basis is in the stock. It has no effect on my basis. In a partnership that has implications to the outside basis in the partner. And the reason being is because I may be on the hook for that liability in a worst case scenario if the partnership defaults on repayment. I'm an owner of Apple Corporation. If Apple defaults on its debt, super unlikely possibility, that I'm not on the hook for that debt. The only thing I'm on the hook for is my stock, right? And the stock could be worthless because I'm a shareholder. But in a partnership, I might have to satisfy that liability. Okay? That's why it affects my basis in the partnership. So, if a partner treats any of its own liabilities assumed by the partnership as a distribution from the partnership. So if part of my formation is I own a piece of land and the land has a liability associated with it, and I contribute the land to the partnership and the liability follows the land and the partnership assumes the liability, that liability has left my personal balance sheet, right? So I'm better off economically. That's treated as if the partnership distributed cash to me. No different than if I had contributed the land free of the debt and the partnership distributed cash to me and I used it to repay the bank. Right? Liabilities assumed or paid off are the same thing from a distribution from the company. So, it's as if the partnership distributed cash to that. Then a partner then increases their outside basis for their share of partnership liabilities. So you may be either called upon to repay partnership debt or receive reduced profit distributions due to the partnership using cash to repay the debt. So unlike corporations, partners have to monitor the liability position of the partnership. That can be either when a partnership assumes the liability of a partner on contribution, or when there's changes in the liability balance within the partnership. Either it borrows more or repays debt. I may or may not have a higher exposure from a liability perspective rather than less. So the presence of liabilities is a fundamental difference. And one of the reasons why you got to rewire your brain here. We have not talked about that affecting outside basis of corporation stock. Right? It doesn't. But here it does in the partnership setting. So that's one of the things we're going to spend some time on here is talking about liabilities and seeing how liabilities affect the owner's business. And liabilities can have, partnerships can have recourse liabilities. Recourse liabilities is where the lender has recourse to other assets of the partner should there be a default by the partnership on repayment. Okay? Yeah. Creditor has recourse, that means I have options. I have ability to chase other assets if I don't get repaid. Contrast that with non-recourse liabilities. Obviously, I don't have that recourse. I don't have those options. My only recourse is the specific property securing the debt. You usually see non-recourse debt with real estate. Right? I borrowed to buy real estate. Many lenders will lend to you with the real estate being the only security for repayment. Meaning that if they don't get repaid, they can seize the real estate. If the real estate's not enough value to get the creditor whole, that's it. That's the economic transaction that they did when they lent to you. Recourse means they can seek other assets to get fully repaid. Okay? Partners must consider guarantees, other arrangements, and statutory recourse liabilities. So if I have to look at the partnership and is the liabilities in the partnership recourse or non-recourse? For recourse liabilities, only partners bearing the economic risk of loss, the partners that would be called upon in the case of default, are entitled to increase their outside basis. So I like to think of it as, think of the worst case scenario. Partnership does not, they default on the debt. They do not repay the debt, and there's no assets in the partnership to pay it. Who has to pay it? So kind of read the documents. What is the lending arrangement say, and is the partner responsible or not? On a worst case scenario, the bank is not getting repaid. And so you must consider guarantees, other arrangements, and statutory law that may bear upon your responsibility to pay that debt. So are there arrangements? Have you agreed to repay that debt as part of the partnership agreement? Are there guarantees? Did the partner guarantee it so that the bank would lend to the partnership? What about what legal entity do you have? George asked the question if I had an LLC. An LLC will default to be a partnership if I don't make an election to treat it otherwise. An LLC is a limited liability company. Under state law, I am only liable for the amount of equity I put into the LLC. State law will prevent me from having unlimited liability, so that makes the debt of the partnership be non-recourse. Unless I have an overriding, did I issue a personal guarantee to the bank? Those legal arrangements have to be looked at as well. But if I don't have that, then the legal entity can protect me for that. Okay? Non-recourse liabilities, partners allocate the increase to their outside basis according to the profit sharing ratios. So the idea here is non-recourse liabilities is you cannot go to the shareholders, but it might affect their ability to have profits in the future because the assets of the partnership have to go to repay the debt. Okay, so that's the reason we have a rule that says I only allocate the increase to their outside basis according to profit sharing ratio. So I have to look at the legal type of the partnership, whether it's limited or general, and whether the partnership is legally an LLC, because that can bear upon whether it's recourse or not. Okay? I don't do any of this in a corporate world. Right? The only way I would ever have this in a corporate world is if the shareholder somehow went out and did a separate personal guarantee to the bank on a corporate level debt. might see that somewhere in a family situation or a wholly owned founder situation. Okay, let's just work through this because I think these rules sound complicated and they are, but when you see them in practice, they kind of have some intuitive sense. Okay, so 9.3 is Allison.
Sarah and Chance initially each contributed 120,000 and CCS borrowed 60,000 from a bank. And CCS was full. The bank required Nicole, Sarah, and Chance to personally guarantee the bank. The terms were structured so each of the members would be responsible for a portion of the liability equal to the percentage of CCS losses allocated to each member, 1/3 each, and have no right of reimbursement from either CCS or the other members of CCS. How much of the 60,000 bank liability is allocated to each member? So each member is allocated 20,000. The liability is treated as brute force liability because the members are personally guaranteed. Because each guarantees 1/3 of the liability, the 60,000 liability is allocated equally among them.
So this is over and above any basis implications upon the formation of the partnership. I get a basis increase if I was one of these three partners of 1/3 of the partnership debt. And the reason being is because in a worst case scenario, if the bank does not get repaid, they could go to each one of those partners and say, you owe me $20,000. Go get it. I don't care where it comes from your assets. But you personally guaranteed it, that means I get reimbursed. And so that economic responsibility to satisfy partnership liabilities if the bank does not get paid is what gives me the increase in my outside basis in the partnership interest.
Assuming the 60,000 bank loan is CCS's only liability, what is Sarah's outside basis and her CCS interest after taking her share of CCS bank liability? Sarah's basis is 140,000, 120,000 plus 20,000, because it consists of her cash contribution plus her share of CCS's 60,000.
So that prior example, she put in 120,000, so we know we have 120,000 starting outside basis in our partnership, and then I increased that by the 20,000 of liabilities that I have personally guaranteed, my 1/3 of that. So now my basis goes to 140. So you can imagine what happens here. If the bank starts getting repaid by the partnership and the liability goes down, my outside basis goes down, right? Because it's not stuck at the 20,000. If I pay, 10,000 of that, then it goes down by 1/3 of the 10,000. So I like to think of it, the outside basis here is like a living thing in the tax world. It's moving up and down on a daily basis. That's totally different than a corporate setting. Basis doesn't change in a corporation. Okay. When a partnership assumes the liability of a partner upon a contribution of property to the partner must treat the liability assumption as a distribution from the partnership, reducing their outside basis by the amount of the liability assumed, as in the case of any partnership distribution. So we're going to cover partnership distributions in chapter 10. Partnership distributions. When I take a distribution from a partnership, it's non-taxable to me. Why? Because it's not a dividend, right? It's not a separate taxpayer. It's just a distribution from a flow-through entity. The way I maintain, or way I track the non-taxability of a cash distribution is I can take cash out equal to my outside basis. If I take $1 more than my outside basis, I have a $1 capital gain. So the increase in my maintaining my outside basis is very important for a partner because that determines how much cash I can get out of the partnership without paying any tax. Okay? So if I get basis from a liability, that's good because it boosts up my outside basis. It's bad from an economic standpoint because I'm on the hook for that, but that doesn't mean that I ultimately have to pay it. If the partnership is viable and has operations, it can pay off the bank debt. But it means that I can actually get more cash out from the partnership. So, a liability assumption involving an amount in excess of my outside basis can result in current gain recognition. So, anything that causes me to get value out of the partnership in excess of my outside basis, capital gain to the partner. That could be either a cash distribution in excess of my outside basis, or What if I have a liability that's assumed? We treat that as if you delivered cash to the partner. The partner repaid the debt. It's the same economic effect, right? So if that liability assumption is greater than my outside basis in the partnership, I have a capital gain in the assets that I have. Okay? So liabilities are fascinating in partnerships because of this ongoing nature of its impact on the partners, which doesn't exist in that. Okay, partnership level tax implications. So taxability of contributions. Remember, on the partner side, completely non-taxable, very flexible. All I have to do is receive back a partnership interest. No ownership requirements, and I can do it on formation, I can do it afterwards. So the same tax implications that apply at the partner level also apply at the partnership level, as you would assume. The partner's not paying tax, you would assume the partnership's not paying tax. So a contribution of property to a partnership in exchange for that partnership, issuing partnership interest and equity can be accomplished in a non-taxable event. So completely non-taxable to the partner and to the partnership on formation. What would you expect if I told you that? What's going to be the basis the partnership takes in the asset? Carryover basis, right? And preserve that ability. We're deferring it, not taxing it now, but we want to preserve it in the future. So partners generally take a carryover tax basis in the property received. This is what we call our inside basis. This is the partnership now owning the asset. Its inside basis in its assets. Okay? Be a contribution equal to the contributing partner's tax basis at the time of the contribution. So the asset comes from the partnership. I carry over the basis that follows the asset, and the partnership now takes that asset. Carryover tax basis ensures that any built-in gain or losses in the contributed property is ultimately recognized should the partnership sell the contributed partnership in the future. That's our hallmark of deferred transactions. Let's do 9 and 7. Matt.
So assume CCS used the land your co-contributed piece of business for 1 month and then sold it for its fair market value of $150,000, or the amount of carry gain CCS would recognize $130,000 section 1231 gain. That's the whole of the land is a capital asset for basis prior to information. CCS is $20,000 because CCS would receive a carryover basis in the land of $20,000. Recognize $130,000 of gain when it sells the land for $150,000. Also, because CCS used the land in its business because of the full 5-year holding period carries over CCS, the land qualifies as a 1231 asset. Plus CCS recognizes section 1231 gain when the land is sold. Note that $130,000 gain is recognized regardless of whether Nicole sells the land and recognizes the gain and contributes the cash to CCS, or if CCS sells the land shortly after it's contributed and recognized.
So non-taxable upon dropping the asset into the partnership, and I take a carryover basis in that asset that preserves my gain. And what they're saying here is what would happen if the partnership close in time sold the asset. We haven't talked a lot about holding period here, but when you have a rule like 1231, which requires us to use the trade or business asset in a business for greater than 1 year, if you do a non-taxable transaction, typically the owner's holding period it gets added to your holding period, so you count the joint ownership and you're trying to qualify for that 1231 treatment. So that's what's going on here. And so that causes the partnership to have a 1231 gain on this, which again, 1231 means we have to recapture part of the gain as ordinary to extent prior depreciation. Right? So we will pick up on Wednesday with the acquisition of a partnership. We've already formed the partnership interest. Do it largely non-taxable, outside basis is the challenge of the liability. Okay, thank you. We have to
Oh, okay, yeah.
30%.
Okay.
Yeah, I don't think it's need practice. Besides looking good on top. Yeah. Exactly. I'll look over it for like right before. But